Yo guys, welcome to a new video. Today we are going to discuss a new educational topic, a new educational content, and this is probably the reason why you keep losing more money than you expect to lose. And this is all to do with position size. I spoke with someone this week who lost a lot of money with a trade because his position size wasn't calculated and there was no thought behind it. And this is something that's very important for your risk management and also very important for your trading, because if you don't calculate your position size correctly, then you will probably end up losing more money than you want to lose, and your portfolio size will decrease very sharply. So position size. One thing I want to add: if you're trading in futures, don't trade cross. If you don't know what you're doing, cross will use your whole portfolio size or your whole your whole net worth on the exchange. Always use margin, because it only takes the money you say it is allowed to use. For instance, if you use cross margin, you have 10k on your account, then this whole 10k will function as margin for the trade. And if you then get liquidated, then all the money is gone. Okay, so margin is better, especially if you're a beginner. Just use margin. So the position size is something that should be calculated based on your stop loss. And stop loss, as you all know, is not fixed. It's variable. So if you have a 1.5% stop loss or you have a 10% stop loss, the position size will change. Of course, if you don't do that, then your position size will stay the same for the same stop loss, for another stop loss, a bigger stop loss. Then your money will go away very, very fast. If you have a bad winning rate, of course, if you have a 100% winning rate, then it doesn't matter, because you're only winning. So you can't use the same position size for a 1% stop loss in comparison to a 10% stop loss, for example. The goal is to always limit the maximum money you can lose. And this is also called your risk. And your risk is based on your trading style, on the conditions of the market. For example, if you are a very aggressive trader, then your risk will be higher. But for example, if you are very conservative, then of course your risk will be lower. And your risk is the maximum amount of money you want to lose. So in certain conditions for the market, for example, if we are in a strong downtrend or Bitcoin just crashed to 20k, you don't want to put on your risk. You don't want to higher your risk. You want to keep your risk low, because the market is very volatile, and your trades have a higher chance of not being correct than normally. So you want to lower your risk. And how do you calculate your risk? Well, your risk is of course subjective. It doesn't matter. It doesn't matter, but I mean, for everyone it is their own thought. For example, I use 2% risk on my trades, and for a beginner, I would advise to use a maximum of 1% of percent risk. If you're using trades on the lower time frames, or if you're a scalper, then use a lower risk, like 0.5%. Because of course you take a lot of trades, you take way more trades than a swing trader, so your risk should also be lower. So let's say you use 1% risk. Okay, so 1% risk, what does that mean? Well, it means if you have an account of a net worth of 50k, let's say 50k. That is the amount of money you have on your account or your exchange, on Binance, for example. And this 50k, as you want to have 1% risk. That means 1% of 50k. So 1% of 50k is $500 or €500, dollars, doesn't really matter. It's your own currency you want to trading. So if you have 50k on your account and you say I want 1% risk, and this risk again is not fixed. If you want to lower it, you lower it. If you want to make it bigger, then make it bigger. It depends on the situation and it depends on your trading style. But let's say we have 1%, 1% of 50k is 500 euros. So 500 euros is the maximum amount of money you want to lose, or you can lose per trade. Okay, this is very important. You don't want to lose anything more than this 500 euros, because you don't know if your trade is going to be if your trade is going to be successful or not. If it's not successful, which happens all the time with all traders, there's no trader who has a 100% winning rate. There's absolutely no possibility. If it's not successful, you can only lose this 500 euros. Okay, of course, if it is successful, then your profits is also limited to a certain amount. In comparison to if you just have a huge position size and just go in with all of it, then of course if your trade is successful, then your profits will be huge. But this is something you don't want to do. You want to take gradually slow steps and just risk 1% of your account every time. And if you do this, then I'm sure that your account size will go up gradually, if of course your trading strategy is also good. But at least you are controlled about your money, you know what you're doing, and you're just not gambling. Because if you don't do it like this, you're just gambling. That's really what it is. Okay, so we say 1% risk, we have 500 euros, that's the risk, the maximum amount you can lose. Now let's see for a trade, okay? We're going to look for a trade. Let's say we are going to use it to take this trade. Oh, that's just convenient because it's standing there. And this trade has a stop loss of 67%. So what that means is, if I'm going to take this trade and the entry gets hit and my trade goes against me and it's not successful, it goes against me and it gets stopped out, then my maximum amount of money that I'm losing is 500 euros. So this amount is 500 euros. Okay, so if the trade is not successful and I got stopped out for 1.76%, that is equal to 500 euros. How do you calculate this? Pretty easy. I'm Dutch. That's just like this. Let's say again, we have 50k on our account. We have 1% risk. That's 500 euros risk. And our stop loss is 1.76%. And this 1.76% must be equal to 500 euros. So how can we calculate this? Very easy. Just put 500 divided by 1.76%. This is also equal to 0.0176. And that is, let's take a look, 500 divided by 0.167 is 28k, or 28,409 euros. So this is the amount, this 28,409 euros, that is the amount you will put in this trade. That is your position size. Of course, if you're not using leverage. So this is the amount you're bringing in of your own money in this trade. So if your trade gets stopped out, let's say it gets stopped out, okay, so your position size is 28.4k, and you're stopped out for 1.76%, then of course it's just very easy. It's like this: 1.76% is equal to 500 euros. Okay, and of course stop losses are not fixed. Like we said, stop losses can be bigger, can be smaller. Let's say we take the same trade, but I'll just want to be a bit more careful, because I see there's a lot of liquidity above here. So let's say we're going to take this trade. So I'm waiting, taking this supply here, and then we'll just keep the target for now. Let's go a little bit lower. The RR isn't great, but that doesn't really matter for now. So the entry gets hit and we get stopped out again because we're very, very bad traders. Stopped out again. What is the amount we lose? For 3%, 3.04%, which is equal to the 500 euros. So what are we doing then? Let's take a look. 500 euros. 500 was our risk, so 1% of 50k is 500 euros. Our stop loss is 3.04. That's equal to 500. So 500 divided by 0.034 is equal to 500. 0.034. That's equal to 14,705 euros or dollars. So this is the amount that the whole position will take in. So this is the position size, 14,705 euros. Okay. So as you can see, the risk, risk stays the same, but the stop loss is bigger now. It's almost doubled, and the position size has almost went down with 50%. So according to the stop loss, the position size is variable, okay? But the risk stays the same for this situation. Of course, it depends on, like we said, the condition, your trading style. If you're very aggressive, you want to take a lower risk, a higher risk, and vice versa. If you're conservative, you want to take a lower risk. That doesn't really matter. I would advise to use a risk of 1.5%, and that's about it. And if you're very experienced, then you can of course you can go higher. I would just use this for now, especially if you're a beginner. But yeah, so this is how you calculate your position size. Now, if you are using leverage, then the position size the calculation is almost the same, only if you want to take, for example, 10x leverage. So 10x leverage, what you're going to do then is 14,000, so our position size of 14,705 euros divided by 10, because that's our leverage that we want to use, is equal to 1,470.5. Jesus, that was very hard. Okay, so now your margin will be this. This is the amount of money you will put in. You'll put in the trade, in your futures trade, and with the 10x leverage, then this will be the actual position size, and this will also be the amount. The 500 euro will still be the amount you are going to lose if you're getting stopped out. Okay. Yeah, so that's about it. If you have any questions, just let me know, because this shouldn't be too hard, but if you're not very good at maths, maybe it's a bit difficult for you. Just put it in the comments, and I hope you've learned something from it. Thank you, guys.